All right, so we're about to get started in a minute or two. Giving a few minutes for folks to roll in. You know, uh, I'm a person who normally like to start promptly, but I'm realizing social media, you got to give folks time to roll in. Salute to all my day one supporters. Rael, Mo Ticketed, Sheed, we here. I'll probably see you shortly. K Business Podcast, folks like that. This is going to be a fairly short stream, as I'm not going to be on too long, but I think that this next thing is fairly important. So what we're going to go over today is from one of my carriers that I use, and what we're going to look at is the fact that we have something called insights. So insights is something that I don't particularly have to worry about, too heavy on compliance. But the reason that this article is important is because if you're familiar or not, over on TikTok, you have a lot of buy term insurance people and you have a lot of IUL people. IUL is likely my favorite product. And you get these rare challenges from these people who are with companies like Primerica or who are investment only financial professionals, and they try to diminish the value of life insurance. I had a young lady actually today say something idiotic about, only 1% of banks assets are in BOLI, and then I showed her on paper, actually, if you look just with Bank of America, they put $6.4 billion or $6.1 billion into the equity investments without readily determinable fair value, or the investments that you push, like brokerage accounts and things with Merrill Lynch. Meanwhile, they put almost $23 billion into cash value life insurance. That's substantially a larger percent than those investments would be, correct? So even if it is only 1%, it's a whole lot higher than those investments. Now, a lot of agents who don't have the experience that I have wouldn't understand how to counteract that. A lot of agents also don't have the same understanding of these products that a lot of professionals who are in advanced markets do, right? So, they don't quite understand how the mechanics of a product works, so on and so forth. So today I'm going to read an article that was published December 2nd, so just 8 days ago, by Kelly Haverson, who is an industry professional. They're more of an internal wholesaler with one of my carriers. And what they do is they actually sell the product to insurance agents or financial advisors. See, what you, the general public, don't know is that advisors like myself who roll in certain circles and do certain business, we also get advertised to we have to get sold to by the company. So for example, we'll just use the easy the one that everybody bullies, Primerica. Primerica product is so popular to Primericans because someone higher up the chain in Primerica sold the product idea of Primerica to the Primerica agent. Just like somebody who's at New York Life is sold on selling you a New York Life product because the internal wholesalers in New York Life sold the product to New York Life. Those may not actually be the best examples because those are both captive companies. But let's say somebody who is out here who there's a lot of agents calling themselves a broker. And the reason we call ourselves a broker is because you, the general public, don't understand exactly what an independent agent is. And it's a lot easier to just say a broker because you understand that a broker is independent and works for you, not the company. Same scenario here. So let's take a look at this article. 1 second. So, with this article, you have Kelly Haverson discusses the 7 critical red flags in accumulation IUL portfolio management. Okay, so It says here, index universal life insurance policies have surged in popularity to accumulate wealth on a tax advantage basis while providing life insurance protection. And this is absolutely true, right? So you'll get a lot of people who right now the big thing is the IUL, infinite banking with the IUL. Like myself and Rael have had conversations in the past where there are other products or other strategies that will soon be used that I've been talking about for over a decade now, but they haven't been popular, especially in the Black community. Now that you have all these agents who have been in the field for 2 to 4 to 5 years, they haven't done or experienced what a lot of senior seasons agents have. Now they're talking about it, and it's popular, and it's easy to get to everybody because you've got YouTube, Facebook, Instagram, TikTok, Pinterest, LinkedIn, and all these other things, Snapchat, and so on and so forth. But let's read this article. So index universal life insurance policies have surged in popularity to accumulate wealth on a tax advantage basis while providing life insurance protection. However, the complexities of IUL portfolio management can lead to costly decisions that undermine the long-term benefits of these policies. With growing competition in the IUL market, many carriers are using strategies that may seem attractive on the surface, but can harm policyholders in the long run. And this is where a lot of your what we call termites, who are guys who are like, buy term and invest in a brokerage account, ... that is going to be taxable to you every year. So even if you do get those gains, if you get a 20% loss, you need at least a 25% gain to break even. They don't tell you this stuff because most average Americans think investing is the way out. Wealthy individuals invest for preservation of capital, not for growth or not for income generation. So, as a financial professional, it's essential to identify these potential red flags and how carriers manage their IUL portfolios. This guide will walk you, and not just as a financial professional, but you as the consumer. And this is why, especially to the bliggity or the Black community, I call myself the spook who sat by the door, because I go get this information and I don't give you the bullshit like these other people. So this guide will walk you through the 7 most critical red flags, providing insight into how they might affect your clients. The next time you speak with an IUL wholesaler, use this checklist to make sure your carrier isn't making any of these costly decisions. So, just for clarity, as I mentioned, when you're speaking with a wholesaler is going to be someone from that carrier. New York Life, Mass Mutual, Prudential, John Hancock, all these other carriers, and they're going to sell you as to why you should sell their product to your client. And it's not going to be, hey, we're going to pay you the best, because a lot of these companies don't have a super robust contract, which is why a lot of advisors have been switching to fee-based advisory, where yes, we get paid a commission, but we also charge a fee. So let's continue. So one is inconsistent cap rates. So one of the key, you guys need to understand what a cap rate is. So a cap rate is the most interest that will be credited to your account based upon the indice that you're reflecting. So let's say, make it easy, S&P 500. Let's say your cap rate, which means the most credit that you will get credited, or the most interest that you will get credited, regardless of how high the index goes. Let's just use round figures. Let's say the cap rate is 10%. Again, these are arbitrary numbers, but let's say, for argument's sake, the cap rate is 10%. Your credit is maximized at 10%, and let's say the S&P 500 does 30%. The most you will be credited is 10%. Now, there's pros and cons to that, because again, 0 is your hero in the IUL. So while the S&P goes up that 30% and you only get 10%, the overage is used for other things, but also the downside protection. So the downside protection is 0, meaning that there's a 0 floor. Okay, so that when the S&P 500 goes down 35%, right, you don't participate in those losses. So no, you didn't get the entire 30% of gains, which is great, but you also got 0% of the losses. So when the market goes down, inevitably that it will, because just like a lot of these people say, well, the market always does what? It goes up, which means that it always also goes down. Right? So one of the key selling points of an IUL policy is the opportunity to earn market-linked returns with downside protection through cap rates. However, let me make sure that this is hey Malika, how you doing? So one of the key selling points of an IUL policy is the opportunity to earn market-linked returns with downside protection through cap rates. However, many carriers offer attractive cap rates to new clients while leaving in-force policyholders with lower rates. This inconsistency in cap rates can significantly affect the growth potential of a policy's cash value. So why it matters? Lower cap rates for existing clients means that their policies earn less in a strong market compared to newer policies with higher caps. Now, over time, this disparity can erode the value of an IUL policy, leaving policyholders feeling that they've been shortchanged. What to ask? Is the carrier supporting cap rate parity between new and existing clients? If not, what is the justification being given? So, as your social media insurance brother, the all-star advisor, I would also put some of that onus on you, the client, which is why I tell you have to reach out to your agent and say, hey, listen, I need to do an annual review. Remember, we're salespeople and we only get paid off of the sale. So when you as a client come back around, we'll gladly service you, but you have to make us aware of that because we're always looking for the next hit. Imagine, for example, with your real estate agent, when you buy that house, that's it. That real estate agent gets paid. They're done. They're out of your life, right? That mortgage loan originator, once you sign that and get the mortgage and they give you the money for the house, that mortgage loan originator is done. However, with an insurance agent, we're responsible for your payment for the first 13 months. Imagine if your mortgage loan originator was like that. And then they actually kept a relationship with you year after year. Because mind you, a mortgage is 30 years long. So what you want to do as the consumer is you want to find out generally, for example, if you're put on an index like a 1-year point to point, which means you buy a policy January 1, 2024, and it mirrors the S&P until January 1, 2025. January 1, 2025, you want to call me and say, hey, Alonzo, I want to check the allocation. Can we set up a policy review to see if my allocation is the same, if the 1-year point to point is given the same interest or not? This is stuff that the general consumer does not know. So moving forward, let me just check the chat out here. So number 2 is misaligned fund selections. So some carriers push policyholders towards volatility managed funds via a default index option rather than a standard S&P 500 index fund. For example, you might go into the Russell 2000, all right, or the MSC International, which is the Morgan Stanley International, or the Barclays, or the NASDAQ. There's a multitude of indices that each different carrier is going to have a multitude of different indices that will happen. No problem, Malika. And also, you want to keep us going because unlike your real estate agent and unlike your mortgage professional, when someone sells you an insurance policy or an investment product, they get paid year after year. When they sell you an insurance policy, they get paid a big lump the first year. Industry average is 50%. So if you pay $100 a month or $1,200 a year, that agent gets a $600 check for sitting with you for 30 minutes. Now, every year that you keep that policy in force, they're probably going to get $4. $4 isn't much, but, multiply that by 4,000 people. There you go. So they're going to get $4, and these are arbitrary numbers as well. But they're going to get $4 a year for that policy, right? Now, the investment advisor, they get what's called a trail. So let's say they put you in a mutual fund. Not only do they get the money management fees, generally 1% on anything $5 million or less, right? They also get, some get 2 and 20 fees, which is 2% of your net worth, 20% of your capital gains. They also get the money management fees. They also get what's called trails. So as you continue to put into your brokerage account, as you continue to put into your retirement account, they get paid a commission off of that as well. And they have never spoken to you for years and years and years after, right? Now, these are advantages that your mortgage loan originator and your realtor does not get. Okay, so while volatility managed funds can help stabilize returns, they're often managed to a lower option cost than the benchmark S&P 500 account. The gap between the costs of these funds and their S&P 500 index options can create added revenue for carriers at the expense of the policyholder. So why does this matter? The insurer, not the insurance agent, but the insurance company, generally when an IUL is set up beneficial for you, the insured, the insurer or the insurance company gets the most bang for their buck. The insurance agent actually takes a loss. Now, why would we set it up to take a loss? When I set it up to take a loss, it's because every time I've sat down with many of you who are my clients on my YouTube channel, you sit and you look at it and you go, oh, it's that these numbers are amazing at X amount of dollars a month. Can I put $100 more? Can I put $500 more? Can I put $1,000 more? And what would that look like? So the more you put in, the more I get paid based off of what you put in for the year. I still do when I set it up for you. Instead of getting, let's say, 50% of what you pay for the year, I'll end up getting 25% of what you paid for the year. So instead of me getting a $600 check off of you putting $100 a month, I'll get a $300 check off of you putting $100 a month. But when I show you the numbers and set the policy up for you properly, you're going to end up putting $300 or $3,000 a year. So I get a substantially larger benefit for you and I. And the insurance company is happy because they make money too. So now why it matters. The insurer profits from the difference in option costs, while the policyholder expects performance similar to the S&P strategy. Again, the S&P 500 is the 500 best performing companies in the country. So what to ask? Are you defaulted into volatility managed funds? And if so, how do the underlying option costs compare to a standard S&P 500 index fund? Is there transparency about fund performance? You, the client, wouldn't ask that. That is something that I, the advisor, would ask to an internal wholesaler. Right? What you, the client, would ask actually is, do you default to the S&P 500? And what are my other options in terms of funds? And then how may that affect my ROI? Right? And basically you can just say, well, what's the cap rate on ABC XYZ versus the S&P 500? Number 3 is cap rate disparities. So some IUL carriers engage in delinking their portfolios, where they separate investment management of new and existing policies. So as a result, in-force policyholders are left tied to older, less favorable cap rates, while new clients benefit from more attractive terms. Even in a high interest rate environment that would support higher cap rates, carriers often keep in-force policies underperforming by not adjusting their cap rates upward, all while offering more competitive rates to new policyholders. So again, ladies and gentlemen, that's where it lies on you, the client. When you're looking at an S&P, at an IUL, it's not a set and forget product. This is a product that you, the consumer, need to be a little proactive in. Just like any investment, you don't just want to throw money into your 401k and hope that the target date fund 2045 is beautiful for you. That's why insurance companies created the 401k or the DC, defined contribution plan, versus the DB, defined benefit plan, aka pension, because the defined benefit plan put the risk on the insurance company and your job or your employer. The defined contribution plan, aka the 401k, puts the onus on you, the insured or the investor at this point. But you don't know anything about this stuff. You might know what your best friend Bob said is good for him, and I'm investing in QQQ. Guess what? Me and a relative both are diabetic. We both take insulin, but I can't take the same insulin that my relative takes. You know why? Because we have different needs. And if I took the same amount of insulin as my relative, I might die because it's not enough insulin. Or if he took the same amount of insulin that I'm supposed to take, he might die because it's way too much insulin. So you can never be in these investment clubs, especially without a financial advisor there, and be like, hey, we're all investing this. A broken clock is right twice a day, right? People are investing crypto. Oh, I made $10,000 off of crypto. No, you didn't. You made $10,000 off of some fucking sucker who thought that they were going to get something else. Anyway, so why this matters. So, I already read that. So what to ask? So you want to ask, has the carrier delinked its portfolio management strategy, resulting in lower cap rates for in-force policies compared to the new ones? And why aren't existing clients benefiting from current market conditions, especially with interest rates staying high? So interest rates in the recent year are very high for the insurance companies and carriers, right? Like I said, this isn't going to be an extremely long live. I'm just pretty much going to go through this. I may open it up for a little bit just to get a couple of questions. But let's see. So, red flag number 4 is benchmark index manipulation. So, some carriers manipulate benchmark index participation rates, changing how the index accounts is interpreted in light of IUL illustration regulations. For example, they may adjust the participation level from 100% to 105% or higher, avoiding the moniker of a benchmark index account. However, this tactic appears to be used in order to allow a higher illustration rate, typically for the volatility managed funds, than what can be offered when it has a true S&P 500 benchmark index account with a cap and a 100% participation rate. So what you'll have is, like, a lot of these guys will run around and say, hey, we got like I showed you guys recently an IUL with a volatile index, and there was like a 267% participation rate. Now the illustration rate stays the same, and what the illustration rate is there's a law called AG 49. Because a lot of insurance agents were coming in being unscrupulous, saying, I can put you in the IUL and I can get you 60%. And they can't. And then they'd illustrate it at getting you 60%. And then when you got 16%, you're pissed off. So they would overpromise and underdeliver as opposed to underpromise and overdeliver. So AG 49 allows us now to actually underpromise and overdeliver. But it also keeps the laws off of my ass and keeps you happy. Because when I tell you, you're going to only, if I illustrate it and I say, hey, you're going to get 5%, and then you call me at the end of the year and we look at it and you're getting 9%, you're going to be like, Alonzo, you said I was only getting 5%. How dare you give me 4% more than I was going to earn, right? Nobody's going to be highly upset that you got more percentage than not. Now, why this matters? While an increase in participation rate may sound like a good thing, it can be used solely to inflate the illustrated rate that can be shown in an illustration, typically for the volatility managed funds. So what to ask is, has the participation level of your S&P index account been altered? Are there accompanying changes such as lowered cap rates that could diminish the benefits of this adjustment? Generally, the S&P 500 is going to be the benchmark, ironically enough, and that's what you're going to look at or look for. Most people, when they're getting into an IUL, should just allocate everything to the S&P 500, unless you're at a certain income level, right? But just like investing, unless you have, the risk tolerance to lose $25,000, then you really shouldn't be investing, because FINRA even says when you're day trading, you need $25,000. And as a financial advisor, when I charge money management fees, if I charge you, 1% on 50,000, that's only $500 a year. So most agents aren't really interested in people who have 25 to 50 to maybe 100,000. Now, once you have, 250,000 and I charge you 1%, that's still only $2,500. But at least it's something that is substantial that I can actually pay my bills with, right? Because we get paid 100% commission. So, number 5 is loan arbitrage structure abuse. So, participating loans are a common feature in IUL policies, allowing policyholders to borrow against the policy's cash value while still earning interest on the loaned amount. So, this is again why I say it's substantially more likely a better idea to borrow from your life insurance than from your 401k when you're looking at, things like purchasing a home, because borrowing from your 401k affects your debt to income ratio. However, a lot of people will abuse this arbitrage. So the arbitrage means this. I got $100,000 of cash value in my life insurance policy. I borrow $50,000 of cash value from my life insurance policy. Then if you were to borrow that 50,000, let's say, versus a brokerage account. So here's how it works in a brokerage account without arbitrage. I got $100,000 liquid in this brokerage account. I borrow $50,000. So now my brokerage account, if I look at the balance, it has $50,000. So I'm earning interest on $50,000. However, the arbitrage in an IUL allows you to go, I have $100,000 of cash value in my life insurance. I borrow $50,000, but I still earn interest on that account as if the $100,000 is in there. So that can be kind of a benefit there. So again, loan arbitrage structure abuse. So participating loans are a common feature in IUL policies, allowing policyholders to borrow against the policy's cash value while still earning interest on the loaned amount. However, some carriers are using the synthetic loan arbitrage structures that exceed the 50 basis point limit set by AG 49. Remember, I just told you guys about that law. These structures distort the illustrated income that policyholders might expect. This creates an overly optimistic picture of potential incomes that are dependent on loan arbitrage to achieve exceedingly high levels of distributions in retirement. So again, like I said, this is where people will illustrate and say, hey, you're going to get 60%. And then they show you on paper, you're getting 60%. And then you in turn get 16%. You'd be highly upset. Well, again, due to AG 49, that law, you're really not supposed to be able to do that. You're supposed to just show, hey, listen, I'm showing you 4.9%. Because I've seen some people who are like, oh, yeah, we're illustrating at 7%. Most of the carriers that I go with, which are A+ and A++ rated or highly rated carriers, are going to illustrate no higher than maybe 6%. You're not going to see them illustrate 7 to 12%. Some of these policies are earning 8 to 12 and more percent, but we're not going to illustrate that to you. We're going to underpromise and overdeliver. So now why it matters. Misleading illustrations can cause policyholders to make decisions based on inaccurate projections, particularly when it comes to retirement income planning. If loan arbitrage structures are abused, the policyholder may face lower than expected returns and diminished financial standing in retirement. So what to ask? Is your IUL carrier adhering to AG 49's 50 basis points limit on loan arbitrage structures? Are the income projections based on realistic assumptions? Does your IUL carrier have a large AV bonus or only a bonus paid on loan values that increases the illustrated loan arbitrage as well above the 50 basis point limit? So let me put this into layman's terms that you as the consumer may be able to ask. Are you adherent to AG 49? Realistically, that's kind of all you really need to ask. And most agents aren't going to be familiar with AG 49. So, red flag number 6. Let me check the comments here. All right, and ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, hit that notification bell so you're made aware every time I release new content. And as always, share. Let me put the banner up. Hold on. If you want to feel so inclined to support, my Cash App is growing across the screen. So, number 6 is aggressive investment strategies, right? So, to support higher yields on IUL policies, some carriers invest assets in riskier financial policies, such as collateralized loan obligations. While these investments may offer higher returns in the short term, they also carry greater risk, especially in times of economic uncertainty. So why this matters? Riskier investments can lead to greater volatility in the company's investment returns and added risk to their financial stability and capital position. This could negatively affect the financial strength of your carrier and ultimately the security of the IUL policy. That's kind of fear-mongering in my opinion. What to ask? Is your carrier investing in large positions of higher risk assets such as collateralized CLOs? If so, what measures are in place to protect policies from the associated risks? So actually, that's a question you can ask. And, most agents aren't going to know what a CLO is, right? Especially a lot of these fly-by-night IUL agents who think the IUL is the answer to everything. The IUL is a great answer to a lot of things. However, just like just like the investment advisor ain't really trying to spend time with you if you got $25,000 or less. The IUL ain't really going to work for you if you're not putting a certain amount of money in there. Just like if you want to contribute to your retirement, if you put, I don't know, $50 a month, yeah, it's going to do something, but realistically, it's not going to move the needle for what you need it to do. That's why when you talk about things like contributing to a 401k and a defined contribution plan or a DC plan, right, which is a 401k, which puts the investment risk on you, the consumer, they talk to you about putting a percentage, right? Like they'll say, oh yeah, we have a 401k with company match up to 3% or 6%. They don't say X amount of dollars. They say a percentage of your annual income, because investment experts will tell you that generally if you're going to invest, you need to invest around 1/3 of your annual income, or at least 50K. So that an advisor like me, when I come around, you're putting 50K a year, that's $500 a year, right? That's a week's paycheck. So I got to find a bunch of people to get 50K to actually make a living in this field, right? It seems a lot different. People think, oh, you're a financial advisor, you should have all this money. No, we are we make $0 a year on paper. We don't have a salary. Our salary is earned by what we go out there and pioneer and create, just like a business owner. Just because you own a business, or just because you own a wing spot, doesn't mean that you're making all this money, because you got overhead, right? You've got all those costs. And then you've got payroll, right? I'll give you an example. When I was in New York and I had a personal assistant, I had to make sure I had to get commission. And sometimes I couldn't bring home money for myself because I had to pay my employee, right? I have a relative who owned a barbershop. He had to end up closing it down because they were like, oh man, son, you got all this money. But what they don't realize is, yes, he has all this money coming in, but he's got more money going out than he has coming in, especially to his personal pockets. And by the way, don't feel sorry for me. I knew the job was hard when I took it. I get it. I'm just letting you people understand because, again, as the spook who sat by the door, I'm going to give you the reality instead of the bullshit. So, he had to deal with the fact that he had X amount of barbers, right? Some weren't paying their chair rent, this, that, and the third. And they're, oh man, you got it. The barbershop's making a bunch of money. No, it's losing money. And now it's losing more money because you're not paying your chair rent, but he still has to make sure to keep the lights on so that you can come perform your job. Right? So, anyway, number 7 is offshoring liabilities to enhance earnings. So, some carriers move liabilities to offshore jurisdictions such as Bermuda or the Cayman Islands to improve their financial standings, enhance yields, and reduce capital requirements. While this can benefit the insurer's bottom line, it may create concerns about transparency and stability for policyholders. Now, this particular one, even though it is a little fearmongerish, I actually was unaware, and I'm glad I read this article, that carriers were doing this or offshoring, because offshoring is definitely something that it's a carrier I wouldn't bring to my clientele basis. I'll put it to you like that. If I find out that a carrier is offshoring, I don't like that personally. I want U.S. bonds, U.S. options, right? I want you to do things here in the United States, especially if you're, doing it, offshore like the Caymans, or in Bermuda. There's a lot of shaky ground there. So that would tell me that that's probably not going to be a highly rated or a strong financial strength company, right? The carriers that I represent are definitely top of the line when it comes to their financial strength. And as you guys know, at the end of this, what I'll probably do is I'll put a link in my community panel to the actual article so that you guys can actually read it yourself. Now, why this matters. While offshore structuring can result in lower capital requirements for the carrier, it raises questions about the long-term stability of the policy. Policyholders need to be aware of how these moves might affect the overall risk profile of their policy. And then what to ask. So is your carrier using offshore jurisdictions for their portfolio? How does this affect the risk and return profile of IUL policies? Now, that to me is a great question. And that I would just ask. Most agents aren't going to have a clue. Again, I can't say that all of the carriers I use don't do this, but 9 out of the 10 of them wouldn't be doing this. And then the 10th one would now make it 9 out of the 9 because I wouldn't bother to place any business with that carrier who's doing that offshoring unless I could sit down and have a conversation with the wholesalers and figure out the fuck why. So, by understanding these 7 red flags in accumulation IUL portfolio management, you can make more informed decisions about the policies that you recommend to your clients. Be sure to ask your IUL wholesaler the tough questions to ensure that your client's policy stays competitive and aligns with their long-term financial goals, right? Yes, this was very helpful. So, let me stop here. And let me just give a brief link. See if anyone has any brief questions. And then I'm going to get ready to get out of here. So I'm going to go grab me some water. I'll be right back. Actually, while I'm at it, hold on. I'm going to go grab a drink, play a little music for y'all. And then when I come back, if nobody asks any questions, then I'll close it out. All right, I'm back. So it looks like nobody wants to come up at the moment. That's no problem. So with that being said, ladies and gentlemen, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance brother, and I've just whapped and tapped on your head with another ADH Wealth Solution. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.